Welcome back to Real Estate Investing with Alex Deacon. Alex, good sir.
Hey.
We normally go into a little. We'll get to the real estate stuff real quick, but since we're putting this out right before the Super Bowl, and I mean, not that anybody in Pittsburgh cares, not that they're out of it, but in a way they kind of do. So, Alex, I got to get your prediction. We talk about it enough on here about how great a system is and how building a team is, and we always reference New England Patriots randomly. And they are in the Super Bowl this year against the Los Angeles Rams, who should not be there, but that's a whole different hill to die on. Anyway, who's your prediction, Alex? You got the Pats or the Saints? Pats or the Rams?
I think I New England last year, right? And I was wrong. So
it's still hard.
I'm still going New England because they are the bomb. What are you gonna do?
It's hard to go against Brady. It really is. It is hard. Ninth Super Bowl, man. That's insane. So now let's get to the good stuff while you're really here, guys. Welcome to Real Estate Investing with Alex Deacon. My name is Adam. Obviously, you know the good Deacon here, the Deacon of Real Estate, Alex Deacon. Today, what we are going to be talking about, we've touched upon it before. Every once in a while, we think it's good to give a little update on it and just kind of ease everybody down a little bit. But we are going to be talking about the real estate bubble. Is it happening? Is it not happening? Is it bound to happen? And we're going to dive into that and how to protect yourself if something is on the horizon. So, Alex.
Yes.
Where shall we start today, good sir?
We can start with Google.
Google.
Bubble and bursting.
The tech bubble might be bursting quicker than...
Bubble burst. Yeah, we did talk about this before, but I mean, it can't hurt. We're just going to... sometimes we touch on points and we miss some...
New year, new ideas, maybe,
But... I'm thinking it's coming, right? Because every 10 years or so, it seems like it comes our way.
So, and I remember you put up a website last time when we were kind of looking at trends. Now, and I know we are getting a lot of listeners from not only all over the world, but, throughout the United States too. So every market is going to be different. So keep in mind, we are going to be discussing a little bit about Pittsburgh, but we are going to pull up other cities as well to just kind of take a look at some markets here or there and the history of their real estate market and the trends that they've seen, along with how Pittsburgh is fairly stable compared to most markets in the country. So,
yeah, without spending too much time online and trying to find a chart that would kind of suit what we're talking about, but we look at different parts of the country, and we've talked about areas like Seattle and San Francisco, and what are probably some other really hot markets. Probably New York, Boston,
right?
I'm assuming, but I know Seattle was really pumping out the prices.
Yes, it was.
I think San Francisco too. But you'll notice that those markets, for what I read, have cooled down. And usually, what happens when it cools down in a market that was doubling prices like since 2009. So that 2009 was like the tail end of the last crash. The tail end. It was actually on the upswing, right? Coming back up. And since then, the prices have almost doubled in some of these areas, which is insane because they were already expensive to begin with. So like a house that you could buy here maybe in Pittsburgh was $150,000 would be $300,000 in San Francisco.
Yep.
And now that the prices have doubled, so that same house in Pittsburgh, so it might be double, right? Because Pittsburgh didn't feel the crash. Some areas did. Therefore, those areas dropped in value immensely. So now you're looking at a house in Pittsburgh versus a house in one of those areas. It's going to be double the price. Now it's triple the price. Because let's say Pittsburgh, so let's say that same house is $150,000. Now it's $200,000 in Pittsburgh. It's now $600,000 in some of those hotter areas, maybe even higher. I don't really know the exact numbers. I'm just
spitballing.
Just so you understand, Pittsburgh. It's very hard to lose a significant amount of money here in Pittsburgh unless you just make a lot of little poor decisions. So you make a lot of them. Like you buy 50 or 100 homes in a 3-year period, and you're not doing your homework. By the time you get to realize that, oops, I made some mistakes, and I bought these properties, they're going to need lots of work, and the appreciation is not there like I thought, the rents aren't going up like I thought, all my costs are higher than they should be. and you make all those little mistakes times 50 or 100 times, then you hit a crash on top of that. So the perfect storm is, ouch.
Right.
Now you have a portfolio that's underwater, losing money, and you have to keep that float afloat.
Right.
Wait.
That boat afloat. That float a boat.
You have to float a boat in the bubble. You have to keep the boat afloat, which means you're writing checks every month. So you just have to be really careful when you know a bubble's coming or you can feel it. It has to. You don't have to be an economic Harvard graduate to know that you just can't continue you can't continue doubling prices in 8 years when your income's not doubling.
Right.
It's everything's just it's like common sense. I mean, so you have to look at those indicators, and maybe at some point you should always be careful, but you just need to tend to slow down a little bit and see where the chips may fall, because in a bubble is a time where you can make a lot of money, but you have to be smart about it and knowing when you hit the floor and when the ceiling is impossible. You never know when the floor is coming, and you never know when you're going to hit bottom. You never know when you're going to hit the ceiling. You don't know that, but you can at least anticipate where that's going to be. Then when you get closer to where you feel bubble is going to hit you, you got to be careful what you're buying. So you can't be caught buying maybe some very high-end homes in a bubble, because I think probably those ones are the ones that get hit the worst. Maybe or maybe not, but if you hit with a $2 million flip, right? Which I've never done anything close to that, but I'm sure that's commonplace in some other markets. It's very uncommon here to do a flip like that, even $1 million flip. But let's say you get caught with one or two of those, and in an area where it's worth $3 million today, but right after the bubble, it's worth $2.5 million and declining from there.
Right.
So you can see how you get hit with a couple of those. Could be $1 million loss easily, and you're stuck with an asset that you can't rent and cover the cost. You can't find a tenant who wants to pay $30,000 a month in rent or $20,000 a month in rent. They're just not there. So you got to be careful when you're doing flips on what you are flipping at that time when you feel a bubble is on its way, because you have to have a safety net, and that safety net's going to be, I'm going to have to hold on to this or take a small loss or sell it at a break even. One of those three scenarios, right? Sell it at a break even and just be happy that I didn't get stuck with it because of the situation economically. Or two, sell for a small loss and say, again, just be happy. No, I lost some money, but it could have been a lot worse. Or three, you're renting it out, you're covering your costs, and you're going to ride the wave throughout the downturn. And then eventually it's going to come back. It always does. But you don't want to get caught with 5 or 6 or 50 or 60 of these properties that you're flipping at one time. Now you have an inventory that's massive, and you don't have a market for it. So you have to be cognizant of the market at all times.
Now, Pittsburgh, comparatively speaking to other markets, because I think, like Vegas right now is probably one that's, potentially going up. I agree. I read a lot of the tech areas, your Seattle, nice call, San Francisco, that, the Bay Area, Silicon Valley. They're kind of having some trouble right now because there is a tech bubble going on at the same time. But that's a different podcast that I'll do for a different business at a different time. Now, but that's in Pittsburgh though. We tend to be a little more stable than most of the country. So, Alex, what do you think the best ways of really, I guess, protecting yourself if we think a bubble is coming? What are some best practices that you could really just safeguard yourself from that? If there really even is an immense loss, I'm sure everybody has an immense loss anywhere. But if you're smart, how can you avoid that even substantial losses?
Well, just be careful what you're buying.
Mm-hmm.
That, let's just say, like for instance, we do maybe 2 or 3 flips a month, and these aren't massive profit centers, but they pay the bills and they work well, right? But almost everything we do, if we can't sell it, just because of the price point we're in, if we can't sell it, we're usually able to rent it and be fine. I'll give you an example. I just did one recently. I'm looking at Las Vegas here on Google. Real estate charts. Yeah, you'll see from year 2000, Las Vegas real estate just took off, and it went from 2000 to 2006. Prices
skyrocketed.
Doubled.
Wow.
Prices doubled. How is that even possible? Yeah, from 2000, average home price was 150. In 2006, actually 2006, between 6 and 7, they peaked at 350, so they doubled in 7 years.
That's amazing.
That's just insane. So doubled in 7 years, and then from 2007 till 2012, it hit rock bottom in 2012. This is Vegas, and in 2012, it even dropped below what it was in 2000. So in 2000, 150. In 2012, it dropped to $130,000 a house. And now this one stops at 2014, but I wish we could go further. I bet
I'd be interested to see.
It's probably back up to where it was.
I think so too, because especially now with them getting that hockey team, getting the Golden Knights, and with the Oakland Raiders moving up there, it seems like they're aiming. They're actually getting more.
Because if you look at the Pittsburgh
it's a straight
chart,
line.
it would just be steady incline,
which is good in this.
And then it's a slight drop off in 2007, and then it's just a steady incline again.
I think when we pulled it up last time, the drop off wasn't even that bad in 2007.
Yeah, you can't even see it.
Yeah,
right.
Yeah, it was
you
very.
You have to zoom in and look like really close. Like this is showing 87 to 2014. Now from 1987 until year 2000, Vegas real estate went from 100 to 150,000. So that's 13 years. It went up 50%. In 6 years, it doubled. It went up 100%. Yeah,
that's incredible.
So I think you have to look at those types of the areas you're going to invest in. Look at that, and you can even look at. See, Pittsburgh's so much different. So you don't have to be so enamored with like super appreciation, and you don't have to look so close at these charts and graphs, because if you play it safe, and that's the way I do it. I know what my market is. I know where I want to be. I might do a flip here or there that I know I can't rent it out if I have to and break even. And I just did one recently. I did one in South Fayette where if I was to sell it, I would have lost $10,000, and I was kind of okay with that. Right. I was like, okay, I screwed up. I made some mistakes. I bought something that I thought the value was going to be much more. It wasn't. What am I going to do? Right. So I ended up just renting it. So right now I'm renting it, and I'm probably losing. We've talked about this many times. I might be losing $150 a month or something like that. Right. But in the long run, I have a nice asset that's absolutely turnkey, needs nothing for quite a while, and eventually in 5-6 years or less, I'll sell it and make a small profit. In the meantime, I'm getting some nice tax benefits along the way. But I didn't open myself up. I didn't expose myself to huge liability. That wasn't a $400,000 or $500,000 house. And it's not any sort of bubble here at all. I mean, we haven't felt anything like that. Right. So if this would happen, in a bubble atmosphere, it would have felt even worse. Like I would have had to sell it for a $20,000 or $30,000 loss. Which is, again, it's palatable, but it's not something I enjoy.
Right. Yeah. Right.
So that's one I'm just going to hold on to, and I'll weather the storm. No problem, because you're going to make those mistakes. So you had asked me, what can you do or what can't you do to avoid this? It's just be smart with what you're buying. Don't get in over your head. Have too many flips going at once. Have a lot of money out there, which is just going to drain your bank account. And until they're ready to put on the market, then when you put them on the market, and if you get hit with that bubble scenario, then you're really going to be in deep doo-doo.
And one thing you always talk about too is especially in the Pittsburgh market. I'm not speaking for other markets because it can be volatile in other markets, but because we're very fairly boring and stable here in Pittsburgh. Alex, I know you can embellish this, but you always, stress don't panic, ride the wave. You know what I mean? Kind of just play it out. Why is that so important in Pittsburgh? Is it because we are so steady? You know what I mean? The consistency here is the lows, you're going to feel it, but not as much like you said. You're not going to feel those lows like other cities. The highs, again, you might, but sometimes consistency and stability, I think, is a great reason not to panic and to invest in Pittsburgh, right?
Yeah, Pittsburgh doesn't have any sort of huge influx of population coming in. I mean, we just don't have that. I guess it is kind of boring. We don't have the population growth. Therefore, how can real estate really rise a whole lot if you don't have any sort of economic factors?
Mm-hmm.
You don't have any population growth.
Mm-hmm.
Therefore, our real estate seems to be, relatively stable. It has appreciated quite a bit, though. Like, we're feeling a boom here in the past 4 or 5 years,
mm-hmm.
and that boom, it's not going to be double, values of homes, but some areas have gone up. Some areas have gone up super significantly, right? But for the most part, if you look at Allegheny County in a vast group, you're looking at 3% appreciation a year on average. It's probably tripled or quadrupled that. We got some areas, the house is selling for $200 in 2018. 2019, it's going to sell for $220.
Right.
That's 10% in 1 year. That's a boom for us.
Yeah, that's not bad. That's not bad. Let me see. So what else do you want to sprinkle on here about the real estate? I saw you pulling some graphs up over there.
The graph for. You never know what's accurate and what isn't on Google, but this kind of does confirm what we talked about in Vegas. 2007, the prices dropped. No, I'm sorry, 2012 they were around 140, 130.
Okay.
And 2017 they're up to almost 220. So that's a significant. That's what, 5 years?
Did it jump right back up? Now, did it jump up higher than its peak in?
No, it didn't. Okay. It doesn't compare to the other chart where they were 300,000.
Gotcha.
Experts say recession could hit early 2020. I don't know what the experts if they know.
Who are these experts? Yeah, I never know who these experts are.
Most of them are wrong. I mean, how can you predict?
I mean, and can't we all just say we're experts? Yes. I am not an expert.
We are both experts.
In certain ways, yes, we are.
We are experts at not being experts. That's what we are.
I like that.
I'm an expert at. I'm like the weatherman. I have no clue.
I am expert. I'm not even going to try and say what I was about to get out. It's a Monday.
We're experts at being experts. That's what we are. But so there's our bubble conversation.
Big thing is, don't, be aware, but don't stress. That's why we like to put this out there every once in a while, guys, because it's, everybody talks about it. Everybody seems to stress about it. Even, myself, I'm just kind of a marketer here. I do a lot of internet marketing, do the podcast with the great man here. And to be honest, I hear a lot of it from different advisors, different agents. So I can tell there's a nervousness out there. That's why we thought that it was important just to every once in a while touch base and let you guys know, be aware, but don't panic.
Mm-hmm.
Deep breaths. We're all going to make through it, and especially here in the Pittsburgh market. There's ways to really control any damage, if at all. So,
yeah, then we covered it.
But Alex,
yeah, thank you.
I appreciate you for this, guys. There's another good short one. We hope you enjoy the Super Bowl this weekend. Go Pats if you're a Pats fan, and go Pats if you're a Rams fan. Listen, here's where you guys can find us all over the interwebs. DHREA.com is where you'll find our podcasts, our listings, our blog posts, a little bit of everything about the company. Definitely hit us up there and subscribe to our mailing list while you're there. We send out a lot of great information about Alex's real estate workshops here in the Pittsburgh area, his landlording workshops here in the Pittsburgh, his meetups here in the Pittsburgh area, and a lot of our listings go in our email funnel too. Look for us on Instagram, Facebook, and Twitter under Deacon Hoover. A lot of great stuff in all of those outlets. And if you ever need any assistance, you can email the Deacon himself. It's alex@alexdeacon.com. Guys, if you have ideas for the show that topics that you'd love for us to talk about, shoot us an email. Shoot towards Alex. You can send it to info@dhrea.com. It's another outlet you can send it to. And from there, listen, reviews would be appreciated. Share this, let people know. Word of mouth is big on this. We're doing this for free for you guys because we feel it's a great way to network. It's a great way to do business, and hopefully, we can do business with you. So for Alex, for myself, and everyone else here at Deacon Hoover, we greatly appreciate your time on this, and we will see you next time.